Most people enter trading with one question in mind. How much can I make? Very few ask the question that actually determines whether they will still be here 10, 20, or 30 years from now. How long can I last? Because trading is not a sprint. It is not even a marathon. It is a lifetime discipline. The markets do not reward intensity. They reward sustainability. And that is what separates traders who burn bright and disappear from traders who quietly compound for decades. Not superior indicators. Not secret strategies. Not insider knowledge. Longevity. The ability to stay functional, focused, disciplined, and emotionally intact year after year across bull markets, bear markets, crises, technological shifts, personal life changes, and psychological wear. Most traders never fail because they lack skill. They fail because they cannot survive themselves. They overtrade. They overrisk. They chase validation. They seek excitement. They confuse activity with progress. They trade to feel something, to escape something, or to prove something. And eventually, the market extracts its price. Longevity is not about avoiding losses. Losses are inevitable. Longevity is about avoiding self-destruction. To understand how to sustain peak performance for decades, you must first unlearn almost everything social media, marketing, and trading culture has taught you about success. Because the truth is uncomfortable, and it is slow, and it is boring to people who are addicted to urgency. Longevity begins with identity, not strategy. If you see yourself as a trader who must be right, you will not last. If you see yourself as a trader who must win often, you will not last. If you see yourself as a trader who must make money every week, you will not last. Markets operate in probabilities, not guarantees. Your ego does not. The trader who survives decades adopts a different identity. They see themselves as a risk manager first, a capital preserver second, and a profit seeker last. They understand that their primary job is not to make money today. Their primary job is to still be trading tomorrow. This mindset shift changes everything. It changes how they size positions. It changes how they react to losses. It changes how they experience wins. It changes how they relate to time. Short-term traders think in days. Long-term survivors think in years. And when you think in years, you stop doing stupid things for short-term dopamine. Longevity demands emotional neutrality. Peak performance in trading does not look like excitement. It looks like calm repetition. The best traders do not feel much when they win. They do not feel much when they lose. They have trained themselves to detach outcomes from identity. This is critical, because every emotional spike creates psychological fatigue. And psychological fatigue accumulates silently. Most traders underestimate how exhausting trading really is. Staring at screens, making decisions under uncertainty, managing fear and greed, processing losses, suppressing impulses. Do that without emotional regulation, and you burn out faster than you realize. Longevity requires emotional systems, not motivation. Motivation fades. Systems endure. The trader who lasts decades has rules not only for entries and exits, but for behavior. Rules for when to trade. Rules for when not to trade. Rules for how many losses trigger a stop. Rules for how to react after a big win. Rules for how to react after a big loss. They do not rely on willpower. They rely on structure. Because willpower is finite. Structure is scalable. This is why routine matters more than strategy. Peak performance over decades comes from rhythm. Waking at consistent times. Preparing the same way. Analyzing the same process. Executing the same setups. Reviewing the same metrics. The brain thrives on predictability. When you remove randomness from your daily process, you preserve mental energy for decision-making. Traders who constantly change routines, strategies, sessions, and markets are constantly forcing their brains into adaptation mode. Adaptation is costly. Longevity comes from reducing cognitive load. This is why specialization is non-negotiable. One market, one session, one framework. The trader who tries to trade everything learns nothing deeply. The trader who focuses narrowly develops intuition that cannot be taught. Intuition is not magic. It is compressed experience. And experience only compounds when conditions remain consistent. Peak performance is not achieved by doing more. It is achieved by doing less, better. Longevity also demands realistic expectations. If you expect trading to replace years of income in months, you will sabotage yourself. Aggressive expectations create aggressive behavior. Aggressive behavior creates drawdowns. Drawdowns create emotional instability. Emotional instability destroys discipline. This is the cycle that kills most traders. Survivors break this cycle early. They aim for sustainability, not spectacle. They are comfortable making boring returns. They understand that consistency beats intensity. 10% per year for 30 years beats 50% once followed by burnout. The market does not care about your urgency. It rewards patience. Another critical pillar of longevity is physical health. This is ignored more than any technical concept. Your brain is an organ. It depends on sleep, hydration, nutrition, and movement. A tired trader is a reckless trader. A stressed trader is an impulsive trader. An unhealthy trader is an inconsistent trader. Peak performance for decades requires respecting the body that houses your decision-making engine. Sleep is not optional. Exercise is not a luxury. Recovery is not weakness. The traders who last treat themselves like athletes. They understand that performance degrades without maintenance. They schedule breaks. They step away from screens. They take days off without guilt. Because they understand something most never learn. Missing a trade is insignificant. Missing years of opportunity due to burnout is catastrophic. Longevity also requires a healthy relationship with money. Money is a tool, not an emotional regulator. If trading profits determine your self-worth, your peace, or your identity, you are already in danger. Survivors decouple income from validation. They do not trade to feel powerful. They do not trade to escape insecurity. They do not trade to impress anyone. They trade to execute an edge. This emotional maturity is what allows them to size properly. Overleverage is rarely a technical mistake. It is an emotional one. Fear of missing out. Fear of being behind. Fear of insignificance. Longevity requires confronting these fears honestly. The market amplifies whatever is unresolved inside you. Trading will expose your impatience, your need for control, your intolerance for uncertainty, your relationship with loss. If you do not work on these internally, no strategy will save you. This is why journaling is a cornerstone of long-term performance. Not just trade journaling, psychological journaling, recording thoughts, recording emotions, recording patterns. The trader who lasts is a student of themselves. They know their triggers. They know their weaknesses. They know when they are not fit to trade, and they act accordingly. Self-awareness is a competitive edge. Another element of longevity is adaptability without chaos. Markets evolve. Liquidity shifts. Participants change. Technology advances. Rigid traders break. Chaotic traders implode. Survivors adapt slowly and deliberately. They do not abandon frameworks at the first drawdown. They analyze. They test. They refine. They distinguish between variance and failure. Most traders quit strategies during normal statistical drawdowns. Survivors understand distribution. They know that losing streaks do not invalidate an edge. Emotional reactions do. Longevity also requires boundaries. Clear separation between trading life and personal life. The market should not follow you into bed. It should not dictate your mood at dinner. It should not consume your identity. Traders who live and breathe the market without balance burn out emotionally. The survivors have lives outside charts. They maintain relationships. They pursue interests. They build meaning beyond trading. This psychological diversification protects them. When trading is your only source of fulfillment, losses become unbearable. When trading is one component of a full life, losses are manageable. Peak performance requires emotional resilience, not obsession. Another overlooked factor is humility. Markets punish arrogance slowly and thoroughly. The trader who believes they have figured it out stops learning, stops reviewing, stops respecting risk. Longevity belongs to those who remain humble even after success. They assume they can be wrong. They prepare for adverse scenarios. They never believe they are invincible. They respect uncertainty. This humility is what keeps them cautious during winning streaks. Most accounts are blown after periods of success, not failure. Success breeds overconfidence. Overconfidence breeds negligence. Negligence breeds disaster. Survivors never stop managing risk, regardless of recent performance. They do not scale recklessly. They do not loosen rules. They do not increase frequency impulsively. They grow slowly. Another pillar of longevity is patience with capital growth. Compounding is powerful, but fragile. Small mistakes early destroy exponential growth. Survivors protect compounding by avoiding catastrophic losses. They understand that the first goal is survival. The second is consistency. The third is growth. Skipping steps invites ruin. Longevity also demands intellectual honesty. If something is not working, survivors admit it. They do not blame the market. They do not blame manipulation. They do not blame external forces endlessly. They ask hard questions. Is my risk appropriate? Is my edge real? Is my execution disciplined? Is my expectation realistic? This self-inquiry prevents stagnation. Another critical factor is time away from markets. Peak performance is cyclical. You cannot be sharp every day of every year. Survivors accept this. They reduce size during low-focus periods. They take breaks during mental fatigue. They respect personal seasons. They understand that forcing performance leads to mistakes. Rest is a performance strategy. Finally, longevity requires redefining success. Success is not the biggest win, not the highest monthly return, not the most social media validation. Success is still trading after 20 years with capital intact, confidence intact, and mental health intact. Success is calm execution, repeatable processes, sustainable income, predictable behavior. The traders who last are not the loudest. They are not the most visible. They are not chasing attention. They are quietly compounding. And that is the irony. The market does not reward brilliance. It rewards discipline. It does not reward intensity. It rewards endurance. If you want to sustain peak performance for decades, you must stop trying to conquer the market. You must learn to coexist with it. Respect its uncertainty. Manage your risk. Protect your psychology. Build systems. Preserve capital. Preserve yourself. Because the real edge is not in the chart. It is in your ability to show up tomorrow with clarity, restraint, and patience. Year after year, cycle after cycle. That is the longevity of a trader. And that is how careers are built, not blown. If this perspective challenged the way you think about trading, reflect on it deeply. Longevity is not built in moments of excitement, but in thousands of disciplined decisions no one ever sees. At Wealth Nest Trade Hub Global, the focus is not hype, shortcuts, or illusions. It is about mastery, sustainability, and thinking beyond the next trade. If you are serious about lasting in the markets, not just participating briefly, stay connected. The market will always be there. The real question is whether you will be.